Hello, everyone, and welcome. Thank you so much for joining today. My name is Shaun Floresca, one of the financial consultants with Alliant Retirement and Investment Services, and today I will be discussing the importance of understanding and improving your credit. Now, before getting started, I just want to let you know of some very good educational resources here for you at Alliant. So our team at Alliant Retirement and Investment Services is really focused on helping you understand the ins and outs of investing, saving for retirement, and just so much more. So please take a look at our website, ARIS.Alliantcreditunion.com, to see our list of weekly webinars, our podcast, which is called Invest Savvy, our blog, as well as other financial resources. So here's the agenda for today. First, I'll give a brief introduction to credit. I'll talk about how to access and read your credit report. I'll talk about how to increase your credit score, as well as discuss credit score misconceptions, and finally, knowing your rights when it comes to credit. Let's start with a brief introduction to credit and the types of consumer credit that's out there. Consumer credit is simply personal debt that's taken on to purchase goods and or services. Installment accounts are those that have a fixed payment for a fixed period of time. Examples of these installment accounts are things like mortgage loans, home equity loans, student loans, or car loans. Revolving accounts are those you are not required to pay in full each month. You are allowed to make a payment that is going to be the same every single month until the loan is paid in full. So some examples of revolving accounts include, say, credit cards that are issued by a retail store or a bank. So simply put, credit is for the credit worthy. Back in 1970, the Fair Credit Reporting Act, or FCRA, was created. This law was introduced to protect consumers by ensuring accuracy, fairness, and privacy in credit reporting. It gave individuals the right to access and dispute their credit information. And in 1989, the credit score system was adopted. Lenders began using standardized credit scores to make lending decisions faster, safer, and more consistent. This system reduced bias and improved efficiency in evaluating credit worthiness. Then there is the FICO score, which I'm sure a lot of you have heard of. This was developed in the 1950s by Fair, Isaac and Company. The FICO score became the industry standard for assessing risk. It uses data-driven models to predict the likelihood of repayment. So these milestones collectively transform lending into a transparent, data-driven process benefiting both consumers and financial institutions. In regards to credit score, there are more than 3 scores from 3 different bureaus, which you might have heard of. FICO scores are just the tip of the iceberg. You may have dozens of other credit scores you are not aware of. The other main scoring model you'll run into is the Vantage score. The 3 major credit reporting agencies, which are Equifax, Experian, and TransUnion, teamed up in 2006 to create the independently managed firm Vantage Score Solutions, which just released the 4th and latest version of its credit scoring model, the Vantage Score 4.0. The previous version, Vantage Score 3.0, is still widely used. It can take time and money to switch to a new model, and lenders may not immediately make the change. So some lenders also don't use Vantage credit scores. For example, Fannie Mae and Freddie Mac still require the use of FICO scores, or often older versions of FICO scores, when underwriting mortgages. You might ask why scores are different between the 3 credit bureaus. First, there are different dates. Credit scores can change frequently as new data is reported. For example, if you check your score on January 1st and again on February 1st, it may differ because a credit card payment or new loan was reported in between. So always compare scores from the same date, just for accuracy. Second, there are different models. There are multiple scoring models, and each calculates scores differently. For example, a FICO score might show 720, while a Vantage score could show 735 for the same credit report because they weigh factors like payment history and credit card utilization differently. And third, there are different types of reports. Credit scores are based on data from credit bureaus, and not all lenders report to all three. So for example, if your auto loan only reports to Experian or Equifax, your TransUnion score may be lower because it lacks that positive payment history. So the key takeaway here is that variation in dates, models, and reports explain why your credit score isn't a single fixed number. It is a range influenced by timing, methodology, and reporting practices. Now, there are 5 main factors that influence a FICO score, each with a different weight. Let's start with payment history, which has the highest weighting at 35%. This is the most important factor in a FICO score. Lenders want to know if you have paid your past credits on time, as this helps them assess the risk of lending to you. A strong track record of on-time payments is a significant positive, while late or missed payments, collections, or bankruptcies will lower your score. The second highest weighting is amounts owed at 30% weight. This category is a measure of how much credit you are currently using versus how much is available to you, also known as your credit utilization ratio. A high credit utilization ratio suggests that a borrower may be overextended, which can hurt your score. So keeping your balances low, especially on credit cards, demonstrates responsible credit management. Third is length of credit history, which has a 15% weighting. This factor evaluates the age of your credit accounts. A longer history with accounts in good standing generally helps your score, providing lenders with a more extensive track record. The last 2 weightings are new credit at 10% as well as credit mix at 10%. Now with new credit, opening multiple credit accounts in a short period can be viewed as higher risk, particularly for those with limited credit history. Each application for new credit can lead to what's called a hard inquiry, which can slightly and temporarily lower your score. And lastly, credit mix, also at a 10% weighting. FICO scores consider the different types of credit you manage, such as credit cards and installment loans. Successfully handling various types of credit shows your ability to manage different financial obligations. However, you do not need every type of credit to have a good score. Now, how do credit scores compare in the US? This chart shows the average FICO score increase from 2015 to 2023. So the average FICO score in April 2015 was 695. The average score peaked in April of 2023 at 718, which represents a 23-point increase over the last 8 years. And during this period, the percentage of consumers with scores of 800 or higher also grew significantly. Factors that contributed to the increase in average FICO scores from 2015 to 2023 include: number one, an improving economy following the Great Recession with lower unemployment and less financial distress, believe it or not. Next, there was the expiration of negative credit information, such as missed payments from credit reports over time. There was also an increased consumer awareness of credit scores and credit management, as well as the effects of government stimulus and payment forbearance programs during the COVID-19 pandemic. Now here's a good slide that shows how credit scores compare across the United States. Local economic conditions have a significant impact on financial stability and in turn credit scores. So regions with higher average incomes and lower unemployment rates, such as parts of the Midwest and Northeast, typically have higher average credit scores. Stable jobs and higher earnings make it easier for people to consistently pay bills on time and manage debt, which are the most important factors in a FICO score. And regions hit hardest by past economic downturns, like the Great Recession, experience lasting damage to credit scores. For example, states in the South and West that saw a high number of foreclosures and job losses may have had lower scores for years afterward, as negative information remained on those credit reports. This graph explains how poor credit can significantly increase the cost of borrowing using a 30-year fixed mortgage of $200,000 as an example. This shows the impact of credit score on interest rates and how lenders use credit scores to assess risk. Lower scores often mean higher rates, and you can see the difference in cost over 30 years. So even a small increase in interest rate can add tens of thousands of dollars to the total cost of a mortgage. So for example, if say you have good credit and you earn a 4.5% rate, that translates to approximately $165,000 in total repayment over that 30-year period. Now, say you have not so good credit and you have a 5.5% rate. That translates into approximately $210,000 of total interest repayment over that same amount of time. So the key takeaway here is maintaining good credit isn't just about approval, it's about saving money long term. Here's an example of compounding interest over a period of time. Compound interest, which is the interest you earn on your principal sum plus previously accumulated interest, can have a dramatic effect on the value of money over time. Let's say you start saving now for 10 years and then you stop. When you retire, you'll have $91,880 in savings. That's $30,000 more compared to someone who waited 10 years to start and saved for 20 years. Though you saved money over a shorter period, it had more time to compound. That's why saving now is key. So your credit score can be checked as often as you want for free, and your credit report can be pulled for free once per year per bureau. So I recommend visiting annualcreditreport.com to access your reports. Now, there are two types of inquiries that exist, also known as credit pulls, if you've heard of this term before. The differences between the two are these. So you have a soft credit pull, which is also known as a soft inquiry. This is a check of your credit report that does not affect your credit score. This usually happens when, say, you check your own credit score, or you have pre-approval offers from lenders, or there are background checks done by employers or landlords. This has no effect on your credit score because it's not tied to a credit application. Now, the opposite of that is a hard credit pull or hard inquiry. This is a credit check performed by a lender whenever you apply for a credit like loans or credit cards. So again, when applying for a mortgage loan, auto loan, or personal loan, that is when these hard inquiries occur. Now, these can lower your credit scores slightly, usually by a few points, and this stays on your report for up to 2 years. Multiple hard pulls in a short time can signal risk to lenders. So soft pulls are more informational and invisible to other lenders, while hard pulls indicate you're seeking credit and can affect your credit score. So here is why payment history matters. Payment history is the number one single most important factor in most credit scoring models, accounting for about 35% of your FICO score. Lenders want to see a consistent record of on-time payments. And here are some ways to improve it. I think the best way to do it is pay on time, because even one late payment can significantly hurt your score. So set up reminders or auto pay, because this tends to help avoid missed due dates. You can catch up quickly, or if you fall behind, bring these accounts current as soon as possible. You want to avoid collections, because accounts sent to collections can have a long-lasting negative impact. So an example of this impact is a single 30-day late payment can drop your score by 60 to 110 points depending on your starting score. So consistent on-time payments over a 6 to 12 month period can help rebuild your score. And I want to say that the key takeaway here is building a strong payment history is the fastest and most reliable way to improve your credit score. So what is credit utilization? Credit utilization is simply the percentage of your available credit that you're currently using. It's a major factor in credit scoring models, making up about 30% of your FICO score. And why it matters? High utilization signals risk to lenders, so even if you pay on time, you want to make sure you keep utilization low, because this shows responsible credit management. Now, how do you improve this? Again, keep balances low. Aim to use less than 30% of your available credit. Next, pay down debt, because reducing balances lowers your utilization ratio. You might want to increase credit limits. So by requesting a higher limit without increasing spending can improve your ratio. You might want to spread out those charges. So avoid maxing out a single card. Try to distribute spending across multiple accounts. Now, an example of this impact of utilization is, say for example, you have a $10,000 credit limit and owe $5,000. Your utilization is 50%, which is too high. So paying down to $2,000 drops utilization to 20%, which can boost your score significantly. So the key takeaway here is lower utilization equals a higher credit score. It's one of the fastest ways to improve your credit health. Now, why does old debt matter? Old accounts contribute to your credit history length, which makes up about 15% of your FICO score. Closing old accounts can shorten your credit history and negatively impact your score. So how do you manage old debt? First of all, keep old accounts open. If possible, maintain older credit cards with zero or low balances to preserve your credit history. Next, pay off outstanding balances, because clearing old debts improves your payment history and reduces utilization. And avoid closing paid off accounts. Just because they're paid off does not mean you have to close them, because closing accounts can reduce your available credit and increase utilization ratio. You want to monitor for errors and make sure and ensure old accounts are reported accurately and dispute any of those incorrect negative marks. So for an example of this kind of impact on old debt, closing a 10-year-old credit card could shorten your average account age, lowering your score. While keeping it open, even with minimal use, helps maintain a strong credit profile. So the key takeaway here is old debt isn't always bad. Properly managing and keeping older accounts active can strengthen your credit score over time. Now, why does new debt matter? New credit accounts and inquiries make up about 10% of your FICO score. Opening new accounts can help diversify your credit mix, but too many new accounts or inquiries in a short time can hurt your score. So how do we use new debt wisely? Apply strategically. Only open new accounts when necessary and avoid multiple applications in a short period. Try diversifying your credit card types. So adding a different type of credit, for example, an installment loan versus a credit card, which can improve your credit mix. And as I alluded to before, keep utilization low. When you open a new credit card, use it responsibly and keep balances low to help utilization. Try to avoid hard inquiry overload because each hard inquiry can lower your score slightly because rate shopping for mortgages or auto loans within a short window is usually treated as one inquiry. So here's an example of the impact of new debt. Opening one new credit card and keeping utilization under 30% can help your score over time. And applying for 5 cards in 1 month can signal risk and lower your score. So the key takeaway here is new credit can help your score if managed carefully, but spread out those applications and use new accounts responsibly. Now, debit and prepaid cards have no credit aspect and therefore are not factored into your credit score. So we won't go over this slide in too much detail, but here are some examples of these kinds of builder debt. So you have credit builder loans, which typically are low interest rate, but you don't get the money from this loan until the loan is paid off. You have secured credit cards, which you put down a security deposit of some sort that's usually equal to the card's credit limit, but sometimes less. And then I think the most frequent that I see of these types of loans are secured personal loans, which allow you to borrow against a car, a savings account, or some other assets, including RVs or even furniture in some cases, which are very rare. But I think the takeaway here is consider these types of credits if other types of credits are not easily accessible. Now, it only takes a few months to ruin a good credit score. At the point where if an account is 6 months past due, the account will be charged off, which is one of the worst things you can do to your credit score. So a charge-off is the declaration by a creditor that an amount of debt is unlikely to be collected. So if you've experienced any of the following factors which have negatively affected your credit, you can see how long it's going to take for the negative information to fall off your credit history. The average of most of these, you can see here, late payments, foreclosures, collections, public record, the two types of bankruptcies are 7 to 10 years. So definitely know when negative information falls off on its own if you've been affected by any of those factors. Something called an Experian Boost allows consumers to opt in to providing their cell phone and utility payment history. So this is a service that can instantly improve your credit score. So what is Experian Boost? It's a free service from Experian that lets you add positive payment history from everyday bills to your credit report. So this works with utility bills, phone payments, streaming services, and a few more. And how it works is you can connect your bank account used to pay bills, and Experian detects on-time payments for eligible services, and it adds these payments to your Experian credit file. So it's an instant update to your FICO score based on Experian data only. So here's some of the pros and cons of the Experian Boost. One, it increases your average score by about 13 points. And again, results will vary. The service is free and low risk, and only positive payment history is added. So late payments are not reported. This is also great for thin credit files. It helps those with limited credit history build a stronger profile. Some of the limitations is it only impacts Experian's report. So it does not impact TransUnion or Equifax. And not all lenders use Experian data, especially for mortgages. And I think one of the biggest cons is it requires linking your bank account for verification, so many people aren't a big fan of that either. But either way, if you Google Experian Boost, you can find out a little bit more about that on the Experian site. So here are some common myths and misconceptions when it comes to your credit. One is that checking your credit report will hurt your score. Well, not if done correctly. So a notation called an inquiry goes on your credit report every time someone, including you, looks at your file, and rumor has it that inquiries can hurt your score. An inquiry affects your score only if it's related to a credit application that you've submitted. An inquiry also represents 10% of your credit score. So if you apply for a loan or a credit card, your score might fall because that application suggests you'll be adding debt. But if you simply look at your own credit report, the resulting inquiry will not affect your score. They say that high income equals high credit. Now, your job title and income have no direct effect on your credit score. Scores are based solely on the information found in your credit report. Lenders may still inquire about your annual income, but your income is not included on your credit report or calculated into your credit score. Now, debt and prepaid cards build a good credit score, but these cards are not credit and therefore do not count. So this is one of the biggest misconceptions is if you have a debit card or a prepaid card that helps, it does not. Now, Fair Credit Reporting Act, or FCRA, was created to give you certain rights pertaining to your credit report and protecting consumer credit information. Federal law enacted this act in 1970 to ensure accuracy, fairness, and privacy of consumer credit information. This regulates credit reporting agencies, also known as CRAs, like Equifax and Experian and TransUnion, and how they collect, share, and use data. So you can see here the list of most of those rights. I won't go over all of them, but some of the more important ones that I see often are the right to dispute information in your credit report that you see as inaccurate or incomplete. And you have the right to ask for your credit report once a year. You have a free credit report from each bureau. And again, you can access this through annualcreditreport.com. You also have the right to have older negative information excluded from your credit report. So like I alluded to on a prior slide, if you have negative information that goes longer than 7 years, have that negative information excluded if it's been that long or older. Remember, good credit is all about three main factors. And if you can remember these factors, I feel that you can be on your way to good credit or just maintaining good credit. Now, first is paying your bills on time every time. Second is keeping your balances as low as possible. And third, avoid applying for too much credit too often. And that concludes our presentation for today. I truly appreciate your attention and hope that you'll take advantage of the information and resources we provided. Thank you.